back to the final part of Unit 2. So it's part 4 of the Unit 2. I see Gokul. I'm working as an assistant professor in the Department of MBA in Sri Muthukumar Institute of Technology. And the subject name is Financial Management. Subject code is MB25201, which will come under the Regulation 2025. In previous parts, we learned how to evaluate projects using techniques like NPV and IFR. But all these methods require one critical input, that the cost of capital. Today, we will understand what cost of capital means and how to estimate it. In this session, we will cover what is cost of capital, why it matters much, then sources of cost of capital, then cost of common equity and approaches to estimate. Let's begin. Overall cost of capital of the firm. The cost of capital is the required rate of return on the various types of financing a company uses. Think of it as the minimum return a company must earn on its investments to satisfy its investors, which means both debt holders and equity shareholders. The overall cost of capital is a weighted average of the individual required rate of return for each source of funds. This is often called the weighted average cost of capital. Another way to think about it, cost of capital is the opportunity cost for supplies of capital. If investors can earn 10% elsewhere with similar risk, they won't invest in company that offers less. So the percentage is must for the investors to invest in the company. And this is the formula for the weighted average cost of capital. I will explain the weighted average cost of capital. You can see to the formula WD proportion of debt, RD cost of debt, T tax rate which means the corporate rate, corporate tax rate, which will be included in the sums, which means the tax will be framed and it will be given to the companies by the governments. We have to follow the tax bill. Then WB, the proportion of preferred stock. Then RB, cost of preferred stock. Then WE, proportional equity. Then RE, cost of equity. Then cost of debt. So the various sources of cost of capital, cost of debt, cost of preferred equity, common equity mix, it's a retained earnings, new share issues, debt which includes bonds, loans, etc. A company typically raises capital from multiple sources. Each source has different cost. The overall cost of capital combines these based on their proportion in the capital structure. Let's see about the cost of debt. The cost of debt is the cost of financing when company issues bond or apply for long-term bank loan. YTM, which means yield to maturity, or we are purchasing the bond means there will be some maturity date. So like years, 1 to 3 years, 3 to 5 years, like that, there will be some maturity date. The yield to maturity approach will be employed in the market price of bond is known. Otherwise, debt rating approach should be employed. And there is a formula for the cost of debt. Bond price equal to cash flow divided by 1 plus yield plus cash flow 2 divided by 1 plus yield plus par value is the share of the company divided by 1 plus yield. Then yield to maturity. Yield to maturity is annual return that the investor will make if he purchases bond today and keeps it until maturity. Then cost of preferred stock. The cost of preferred stock is the required rate of return on investment of the preferred shareholders of the company. Formula for the preferred stock is RP equal to DP divided by PV. DP means dividend per share. Dividend is a part of profit which will be given to the shareholders. Depends upon the purchase of the shares of the company, how much shares they are going to. Depends upon the dividend being given to the shareholders. Then we make price per share. Then cost of common equity. The cost of common equity is the desired rate of return expected by the shareholders in exchange for the investment in the company. Estimating the cost of equity is the most challenging part because there's uncertainty about the timing and amount of future returns. Equity doesn't have contractual obligation like debt. Shareholder expectation are not directly observable. So, yet it's crucial because equity usually forms a significant part of the capital structure. Then cost of equity approaches. There are two types of approach. One is capital asset pricing model, then dividend discount. Capital asset pricing. Capital asset pricing model links the expected return on equity to the risk-free rate plus risk premium based on the stock's sensitivity to market movements. So the capital asset pricing model it's have influence over the market movements because in share there will be some up and down gradual increase or decrease in the company shares. So we have to take consider the market movements while doing the analysis for this capital asset pricing model while taking this model for the analysis. Formula is KE equal to RF plus P, which means beta, RN minus RE. RN means risk-free rate, P means beta, it's a systematic risk. Then RE expected market, then dividend discount model. It is also called the Gordon group. It calculates cost of equity based on expected dividend and growth rate. Formula for the dividend discount model is KE equal to D1 divided by 0 plus G. D1, it's a expected dividend per share next year. E0, it's a current market price per share. G, it's a expected dividend growth rate. Both approaches have strengths and limitations, and practitioners often use multiple methods for validation. So, while taking consider for both the model, we have to do some risk-free rate analysis and risk premium analysis based on the stock price. Based upon the share market movements and share market price fluctuation, we have to finalize the movement and then we have to do some analysis so that we will get some final answer which model is best and which model we can continue with. And that brings us to the end of Unit 2 investment and capital budgeting decisions. Across four parts, we have covered the meaning, significance, and process of capital budgeting factors types of project and influencing factors, then evaluation techniques like payback, NPV, ARR, IR, and the cost of capital and how to estimate. You now have a comprehensive understanding of how firms make long-term investment decisions. These concepts are not just theoretical. They are used every day by companies to allocate billions of rupees. In the next unit, we will explore financing decisions and capital structure. Until then, keep practicing these concepts. If you found this series helpful, means please like, share, subscribe. Leave your questions in the comments. Thank you for working with me. Thank you.